What's up, guys? In this video, I wanted to share 7 different things that I wish I knew when I started yield farming. I started yield farming in 2023. I've made a ton of money from yield farming concentrated liquidity pools, but at the same time, because I didn't really have a good system in place, I also lost a lot of money as well. My current portfolio is doing decently well, sitting at 186K right now. And if you guys want to take a look at my portfolio in detail, you could look at this portfolio update playlist. But this video is focusing on the 7 different things that I wish I knew. Hopefully these things make you a better yield farmer so that you don't have to repeat the same mistakes that cost me tens of thousands of dollars. So if you want to avoid those mistakes, then be sure to stick around and watch this video. So let's dive right in here. And before I begin, like always, this is not financial advice. I'm just sharing what I've learned. So hopefully you get some value out of that, but you should be doing your own research and making your own decisions. So I often have the debate of the wide range versus tight range strategy with people from time to time, but most of the time I believe that wide range strategies are safer and is going to allow you to make more profits over time compared to tight range strategy. I personally don't run a lot of tight range strategy. And if I do, it's more of a nested setup where I have a wide range strategy and then there's a tighter range one where the tight range one is still relatively wide, still in range for a couple of months at a time. And then I compound my fees to the wider range one to get more asset appreciation or to my HODL bag for more asset appreciation. But in general, tight range strategies are pretty high risk. You're going to have more apparent loss because that's the way liquidity pools work. The tighter the range, the more aggressive your asset is going to be converted to the other asset when the price moves in one direction. That's where you're going to suffer more apparent loss, right? So that's the first thing to understand. The tighter the range, the higher the apparent loss. And typically, it's going to be very hard to outperform just holding in the market if your APR is not higher than apparent loss. And if you guys have been yield farming for a while, we know that the APR sometimes can be unpredictable. Sometimes there's a lot of on-chain volume, but sometimes the volume just dies down. So your APR dies down. So the tight range strategy would significantly underperform in that scenario. Tight range strategies also have less upside, especially if you guys are putting the majority of your portfolio in liquidity pools, because let's say you're providing liquidity for Ethereum to USDC. If the pool exits the top side because Ethereum went up, you're going to have less capital gains in USDC terms compared to a wider range strategy. So you're going to have less upside. And this is true for crypto to crypto pools as well. Let's say you're providing liquidity for something like Sui to Ethereum or Solana to Ethereum. And let's say Ethereum is topping out and Solana is catching up to Ethereum. If you have a tight range strategy, your Solana is going to be converted to Ethereum at a more aggressive rate, and you're going to have less profit in Ethereum terms compared to a wide range strategy. So less upside there. And on the flip side, there is also increased downside. This is again because the conversion rate is very aggressive. Let's say you're providing liquidity for ETH to USDC, right? The current price is around $4,000 something dollars, but let's say you set the ranges really tight from let's say 3,800 to 4,500. And Ethereum's price just gets cut in half because of a negative catalyst. Then you're out of range and fully in Ethereum since that $3,800 mark, right? So then your downside is much more compared to a wide range strategy. And another downside with the tight range strategy is that you will have to be rebalancing more. And this typically leads to something I call range chasing. Let's say you started here, the pool moved out of range, you chase the range upwards all the way here. And then when the pools dump back down, you're going to be suffering a ton of apparent loss. And of course, you could just hold your ETH at that point, but then you're not earning any yield, and then your overall APR would drop as well, right? So this strategy is not good. If you chase up and then you chase down, what's going to happen is if you keep rebalancing down, you're essentially selling your Ethereum at a cheap price. When the price rebounds, you're going to miss out on the upside and then end up with less capital than what you started out with. So a lot of times range chasing strategy would significantly underperform just buying and holding Ethereum. or just staking Ethereum. And what some people do instead is the snuggle rebound strategy. What a lot of people teach is, let's say you were yield farming back here, right? Ethereum pumps to the upside. If you want to earn yield, you snuggle up by doing this, extending the range upwards. And then when Ethereum drops back down, you're capturing this price action, right? And then when it exits the downside, you snuggle again, and then you basically start widening your range. But at that point, you're also locking in some impermanent loss. If you guys want to learn how to snuggle rebalance properly with much less impermanent loss, be sure to check that out on my channel. Just search for snuggle rebalance and that should pop up the video. But this strategy is not great either because you're going to start tight and then you're going to widen out anyway. And then because you widen out, you're actually locking in some impermanent loss as well. Your APR is going to be lower than what you started out with. So then you might as well just start off wide in a lot of cases. And a lot of times because you need to do more rebalancing, and when you guys rebalance, if you're doing it properly, you have to run simulation. If you're not, it's very likely that you're losing money. And so it makes this strategy more complex and time consuming. I don't know about you guys, but I don't want to be spending my day just managing my positions. I only spend like a couple hours every single month to manage like 5 to 10 different positions. And I don't need to like chase a range to make really good returns, right? I would rather do something high value like making these videos for you guys. And then a lot of people have been asking me for coaching and courses. I would rather spend my time helping people rather than, spending my time just managing these few positions, trying to make a little bit more return. But at the same time, my return could actually be less because of this, right? Less upside and more downside. So again, tight ranges are really high risk. What I like to do instead is I typically set my ranges with a market bias, and I like to look at the weekly chart and sometimes even the monthly chart. For example, I'm currently yield farming Ethereum to USDC. My goal with this pool is not really trying to make like a really high APR. I'm just trying to sell some Ethereum on the way up. And then as I'm converting my Ethereum to USDC, I'm earning some yield in the process, right? My range is from roughly $2,500 all the way to $100,000. And when you hear that range, you might think that it's really wide. It is really wide because again, I'm not trying to capture really high APR with this specific pool. I'm just trying to sell my Ethereum on the way up. Compared to holding, I'm down, and this is completely normal for a crypto to stable pool because we're not really trying to optimize to beat impermanent loss here. Right now, I'm trying to sell my Ethereum for a US dollar profit. You can see this pool went up in value by almost $10,000. By the time I deposited, you can see I deposited 8,000 something dollars and 11 something Ethereum. Now I'm down to 9.56 Ethereum and almost $14,000. I deposited this pool when Ethereum was around $3,500. And again, my goal is to sell some Ethereum on the way up. If I had a really tight range here, I would most likely be out of range already, and I would sell a lot of my Ethereum at a very cheap price. So to me, it doesn't make sense to use a tight range strategy, especially because the crypto market is very volatile. We can never know when the prices are going to just move sideways for a while. We only know that after the fact, right? So why would I have a strategy that has higher potential APR, but then the upside is limited, but then the downside is also much greater? It doesn't make sense to me, guys. And lastly, it's just not scalable if you guys are putting more than 50% of your portfolio into liquidity pools like I am. Using a tight range strategy could get you in trouble really quickly because again, increase downside and decrease upside. You're going to miss out on the pumps and then you're going to have a lot of losses when the market pulls back. Successful investing is all about limiting the downside while trying to capture the max amount of upside when that opportunity comes, right? You guys don't have to listen to me, but I find that personally, I really like wide range strategies. It has made it so much easier to turn a profit compared to tight range strategies. The second thing I wish I knew is that large caps are simply much safer. This is especially true for yield farming concentrated liquidity pools. The reason why is because when we're yield farming, we're not just in range for like a few days at a time. A lot of times we're going to be yield farming the same pair for a few months. I like to target at least 6 to 12 months. If there's a lot of like good profit taking opportunity, I would consider exiting some of my pools into profit. But a lot of times those exit opportunities don't just come in like a day or two. And the reason why large caps are much safer is that it's more established. There's a wider holder base. There's a reason why that it went to a large cap token in the first place, right? Just like buying Bitcoin and Ethereum is likely safer than like buying stuff like Chainlink, Render, or whatever altcoin that is below the market cap of Ethereum. And I just find that larger caps have a higher win rate because there's much less selection of where the capital is going to go, right? There's not a ton of large cap tokens compared to something that is like under 100 million market cap, for example. There's like thousands of tokens to pick from. So when the market is really good, retail is aping into a bunch of different high risk tokens. A lot of the capital is going to find its way to the higher caps first, and the win rate would be much higher. And I'm not saying don't buy lower cap altcoins, right? I still do from time to time. For example, Bonk is a larger cap. Handle, you could argue it's a larger cap as well. Syrup. But stuff like Clanker, Vader, Basis for Everyone, these are all lower caps, higher risk tokens. Same thing with Pixel, it's only around like 15, 16 million market cap right now. But my cost basis for Pixel is pretty low. So these are much higher risk tokens to yield farm with. I'm not saying that it's not good to yield farm, I still do. But the win rate is much lower. You really need to manage your risk properly. Don't just put your whole portfolio into like a low cap token, right? If you want to yield farm that pair because the volume and the APR is really high, we want to make sure that we're more aggressive in terms of risk management and taking profits. So even though I do have a lot of mid to lower cap exposure, I still have the majority of my portfolio in larger cap tokens. And if I'm looking for like a smaller cap token, the range that I really like to find is around 100 million to 500 million market cap. And then if I want to go a little bit mid cap, it's around 500 million to 1 billion. And then if I want to stick with larger caps, then I want to go with 1 billion and beyond. Most tokens that are 1 billion and beyond might have less upside, but they're typically much safer to yield farm with, especially if you guys are holding on to these tokens for at least the next 6 to 12 months for a potential exit. The third thing that I wish I knew is that the asset selection is much more important than the APR. And I'm still getting better at asset selection. I now have a process in place of what to look for and what to invest in. And I lost a lot of money when I was over indexing APR rather than trying to prioritize asset selection. And the reason for this is really simple, guys. This is the chart that I've made. On the y-axis, this is the asset appreciation on the upside, and then asset depreciation on the downside. And then the x-axis, you can see low APR and then high APR. So you could bunch like different assets into like these 4 categories, right? For example, something like Ethereum to wrap Bitcoin might have really low APR, but the chance of it like appreciating in value over time is pretty high. So it's still a really good pool to provide liquidity for. On the opposite end, there might be some like really low cap meme coins that are pretty much dead, and the chance of it appreciating in value is pretty low. The APR is also really low because not a lot of people are basically trading this token. Then that's typically not something that we want to be yield farming in. But this is where most people get into trouble, and I do get into trouble in this from time to time. When there is an asset that has really high APR, but the chance of it depreciating in value is really high, that's a trap, guys. That's because if your fees don't cover the asset depreciation, you will still lose money over time. It doesn't matter if your APR is 300%, 1000%. If it's not sustainable and the fees don't cover the asset loss, you will lose money over time. And sometimes when the market condition is really good, a lot of pools are going to be increasing in value while having a good APR. So these are what I call the gems. Sometimes these categories shift from time to time. For example, the APR might be really good for a while, and then the volume slows down, so it moves from like the gem to the good pool. Or if the token dumps really hard, then it becomes like a trap and it becomes a bad pool in the end, right? But a lot of times, if I am in one of the higher APR pools that have the chance of appreciating in value over time, I typically want to just stay in the pool rather than risk entering into a new pool where I don't know which category is going to be, right? Because we don't know what the future is going to be. If we have really good entries on a particular LP, it could be worth holding on to and just take profits on our fees, right? Don't fall for the high APR trap. A lot of times people try to rush like the money making process. Slow and steady typically wins a race. If you guys think about like liquidity pools, it's kind of like a road that is like this. You might be here right now, and then this is where you want to go. Maybe that's like more money or financial freedom. And let's just say you're driving a car here. If you guys are focusing on asset appreciation, it might take you a little bit slower than like normal, right? You might go really slow here, but then when the market condition is really bad, you're still staying on track here, and then eventually you will get to your target. But a lot of times people try to rush this process. They want to go really fast, right? But a lot of times when you go really fast, you might be like going up and down and then crash and burn and never reach there in the first place. That's the same thing as like gambling too much of your portfolio into like small cap meme coins, trying to make it big really fast. That's how you crash and burn rather than going at a pace that you can control so that you don't crash and burn, right? I'd like to yield farm some high risk plays from time to time, but I know that whenever I bet, I'm not betting the farm. If I lose, I'm going to have another chance to win big in the future. But if you guys try to run like really tight range strategies with like your whole portfolio on a high risk token, for example, that's how it's really easy to crash and burn and lose a bunch of money. And the next lesson I wish I knew is that to always take profits. So because we never know what's going to happen in the future, it's very tempting to just try to hold on for higher, right? Even now, Ethereum is near $4,300. I'm really bullish on Ethereum. There's a ton of ETF inflows. Institutions are accumulating Ethereum. I think it has a good chance of reaching at least $7,000 to $12,000 this cycle. But at the same time, I'm not going to wait for the perfect top to start taking profits, right? Every single month as the market moves higher, I'm taking profits. And if the price draw down, that's a great buying opportunity. But the point is, if you just never take profits, you're going to miss out on a lot of gains. If we look at the previous cycle high here, Ethereum first pumped all the way to $4,300, draws back down to below $2,000, have another big run up to almost $5,000, and the bear market low is just under $1,000. Let's say Ethereum goes up to like $7,000, $8,000, and your portfolio already went up by like 2 to 3x, and you're just holding on for another 10, 20% gain. It's just not worth it, right? I like to take profits more aggressively when the prices go up, and then I want to buy more aggressively when the prices are cheap. So always take profits. Sometimes I exit out of my pools completely if I believe that the market is overheated, the prices are going to come back down a little bit, or if the prices are just really strong, I sell a lot of my fees into like the majors like Bitcoin, Ethereum, sometimes even Solana and USDC. Then I can take more risks later on. Which leads me to the next point. It's risk management. So this is a brain here. So risk management should always be on your mind because a lot of times in crypto, we're basically playing with risk. Taking risk at the right time can make you a lot of money. For example, when Ethereum was trading below $2,000, now it's trading near like $4,300. If you bought Ethereum at that price, when everyone is panicking, saying that Ethereum is dead, that's when you would have made a lot of money, right? I started buying more Ethereum this year since like $2,500 all the way down here. And then back up here, I start taking more profits. when everyone is getting more greedy. They're saying Ethereum is going to like 20K. I start taking more profits more aggressively, especially when it starts to break new high. Enter price discovery. That's a really good chance to take more and more profits. Rather than trying to keep chasing the next play, this is what got me in trouble last year as well. When Ethereum is near $4,000, I just kept compounding my fees, never taking anything off the table. And then when the prices draw down pretty sharply from like $4,000 to $2,200, my portfolio dropped from like 170K all the way to around 60K, right? So we always need to keep risk management in mind. My portfolio is pretty high risk, so I think about risk all the time. Your portfolio might be different if you guys are mainly in like Ethereum to Bitcoin and maybe some stable coins, then you should still think about risk management. But this is really, really important if you guys are yield farming mid to small cap altcoins. And I see people talk about yield farming altcoins all the time as if it's not high risk. Altcoins in general is just super high risk. There's a ton of gains to be made, but a lot of money to be lost as well. Even though I'm sitting in a profit, it doesn't mean that I would always be profitable, right? I try my best to make my profits, but at the same time, I can't control the market. For example, Ethereum has been outperforming altcoins by quite a lot. Others, which excludes the top 10 crypto, is still around like 293 billion, when the high a couple months back was around 400 something billion, right? In my opinion, there's still some gains left in the tank for Q4, but at the same time, I'm not going to wait for like the top to start taking profits, because whenever I sell some of my fees into like either Bitcoin, Ethereum, or USDC, I'm taking some risk off the table, right? Rather than compounding all of my investment into high risk liquidity pools. And the sixth thing that I wish I knew is that more time doesn't equal to more money. The perfect analogy again is just that road that I show you guys. Sometimes driving slowly would get you to the destination faster than if you're trying to go fast all the time, right? Sometimes if you guys are yield farming really high risk strategies, it would pay off and maybe you got to your destination faster than everyone else. But at the same time, really high risk strategy has a much higher chance of losing money. So you might be spending more time trying to squeeze the range all the time, chasing the range, but it doesn't mean that you're going to make more money from that, right? I see some pretty crazy strategy like setting 1% ranges, trying to make a ton of money. But at the same time, if the market dumps really hard, which we never know when it's going to happen, you're going to lose a big portion of your portfolio, right? Especially if you guys are using your entire portfolio on like a high risk strategy. And you can argue that if you have more time, you could use like a little bit of your portfolio to use the high risk strategy. That's a valid strategy as well, as long as you still spend the time to manage your whole portfolio, right? Let's say my portfolio right now is sitting at 186K. Sure, I could take like 10 grand and then use like a higher risk strategy to squeeze out more rewards. But at the same time, if I'm spending all of my time worrying about that strategy, I'm probably mismanaging the rest of my portfolio. So instead of just spending a lot of time like doing a lot of the higher risk strategy, in my opinion, there are a few high value tasks to focus on. For example, you could be scanning for new LPs. That's always good to do. You want to see which pools still pool like a high APR. If the pool that you're in has like suboptimal APR, let's say you're on like Ethereum USDC, on Optimism or Arbitrum or Base, but you find that some other pool on another chain with the same assets have a higher APR, then you might consider hopping there, right? This is why we scan our LPs. And then it's also great to spend your time to manage positions. If your positions are out of range, you should be looking at the chart and trying to see if you should rebalance. Again, I have a snuggle rebalance video on my channel if you search for that. And it's also good to spend your time to track your portfolio. You can't improve what you don't track, right? So tracking is always a good thing to do. It's great to do research on what you're investing in. If you haven't looked into like Bitcoin and Ethereum, why it's good, then we want to look into that. And every token that you buy, you should be doing the research and not just listen to the stuff that you see online, right? It's also great to look at charts. Then we know what's going on in the market. The price tells us a story. If there's like a huge pump or a huge dump, we want to know about that and kind of dig deeper on the reason why. And we also want to keep up with the news in case some of the new events shifts our investment thesis, then we might have to manage our portfolio, right? So these are all high value tasks that we should be doing so that we can better manage our portfolio rather than spending your time on lower value tasks like constantly refreshing your portfolio. I'm still guilty of this sometimes. I just like to see my portfolio, how it's doing. But a lot of times, if you're just refreshing your portfolio like every 5 minutes, it's not going to make it go up. Doing a bunch of complex strategies and active strategies on a small portfolio is a pretty poor use of time as well. Let's say you have like $500 and then you're spending like hours a week trying to yield farm with that $500. You might as well just go work a job and then save that money to dollar cost average Bitcoin, right? You would get a higher return on your time rather than spending your time on low value tasks. A lot of people think that money is more important than time. That might be true if you don't have enough money, but really your time is really valuable because once you spend it, you can never get it back, right? That's also why I prefer more passive strategies rather than really active strategies on trying to make money. Because at the end of the day, spending more time like investing doesn't mean that you would make money over time. You could still be making mistakes. The market is unpredictable. So I don't really like to spend like hundreds of hours per month to have overly complex strategy. And the last thing that I wish I would know is that no one knows the future. That's the truth, guys. Like people that flex like, oh, I entered this, because of that. I made all of the right decisions. I bought Ethereum at whatever prices. I made all of the good decisions. This is why you should listen to me. And then XYZ is going to happen next with absolute certainty, right? It's just doesn't happen. A black swan event could be around the corner and then the market draws down by 70, 80%, right? We just never know the future. Everyone has a chance of being wrong. I used to spend a lot of time just trying to like listen to other people's opinion, trying to figure out who has like the best take of what's going to happen in the future. But a lot of times it's really hard to tell where the market direction is going to go. I'm sure you guys have heard like time in the market beats timing the market. I still mostly have a market bias depending on where the prices go. For example, when the prices are cheap, I typically want to be positioned long. And if the prices look a bit overextended, even though I don't know if it's going to go higher, I like to be positioned either neutral or a little bit short, right? Or less long than where I have been at a cheap price. So that's my pretty simple strategy. I don't really need to like listen to 100 different people about 100 different predictions because at the end of the day, we never know what's going to happen in the future. We just want to try our best to control what we can control and bet on assets that are likely to basically go up in value over time. And this is why I also like to hedge my bets. For example, even though I'm largely long in the market, I'm adding more and more stable coins to my portfolio or yield farm more crypto to stable pools because I believe that there's always a chance that I'm wrong, that the market is going to pull back. And I would be better off if I had that in place rather than, putting all of my eggs in one basket, being long all the time, and then suffer a huge drawdown on my portfolio when the market pulls back, right? And it goes back to the first few points too about risk management and always taking profits because we never know when the music is going to stop and then the next bear market comes. So I hope that was helpful, guys. If I knew those things, I probably would have made much more profits and also prevent myself from making these losses. I hope these videos help you out. And if you guys like the video, be sure to smash that like button and check out my other videos. I go pretty in detail in yield farming. That's what I mainly focus on because it's one of the best ways to make money in crypto. Thanks for watching. I'll catch you next time.